Good afternoon, Wealth Our Way Nation. What is going on? It is your man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform Wealth Our Way, where our motto is wealth is not only for the wealthy. Welcome to episode 56, how to structure retirement investments. I want to thank each and every one of you who are live with me right now as I stream across the Facebook and YouTube Wealth Our Way platforms, and give a special salute and shout out to all of the Wealth Our Way Nation members who watch this program pre-recorded overnight, over the weekend, or anywhere you can squeeze 15 minutes of financial literacy in. And a heartfelt how are you to the 101 members, the Life 101 members who listen to the audio recording of this here program. So what are we talking about today? What do you mean how to structure retirement investments? First of all, you need to understand and learn to differentiate between different classes, different types of monies and assets that go in places. So let me give you a quick 101 update on that. There is a difference between savings and investments. I've talked to you before on previous programs about it, but I'll refresh your memory right here. Savings are funds that are put aside, preferably somewhere where we don't have quick access to them, that will never go down in value. I'll repeat that. Savings they're liquid, they're cash. More often than not, they are cash assets that hopefully you can't get to very quickly, because you'll have the temptation to break in there and spend it, that never go down in value. So we're talking about savings accounts, money market accounts, checking accounts. These accounts that you can put money into that barely grow. Unfortunately, we are in a very low interest rate environment, so you're not making a lot of money on them, but they are there. They're reliable. Now, if you want to try and go for more income on your savings, you can do things such as short-term certificates of deposits, which are known as CDs. There are a lot of other ways to get more bang for your buck on your savings. I teach that on more advanced levels of our webinars and classes and courses. Investments differ from savings, and the main reason they differ is because investments can go down in value. Savings will never be less than the net asset value that you put in. So if you put $1 of net asset value into a checking account, it'll always be $1. It's guaranteed to be $1. It's guaranteed by the FDIC, which is a corporation backed by the federal government, which insures every bank account. I won't get into how the FDIC is grossly underfunded. We won't talk about that. I don't want to scare you to death. But put $1 in, get $1 out. Investments, not so much. You put $1 into an investment, it may go up 10 times to $10, or it may go down to zero. Investments are a little riskier. So now that we know the difference between savings and investments, let's talk about the different investments that we can do. We can do taxable investments, meaning I can open up a brokerage account at any firm or company, online or in person, buy stocks, bonds, mutual funds, ETFs, cryptocurrencies, REITs, real estate investment trusts. I can buy these things and be taxed on them as I go along. There are certain tax strategies that I can use to offset my gains. I can defer taxes through holding things longer and get a lower capital gains rate. But the reality is that it's a completely taxable account. Then there are tax advantaged accounts. These are normally retirement accounts, individual retirement accounts, IRAs, Roth individual retirement accounts, 401ks, 403bs, 457 plans, all of these types of plans that allow you to put money in today, invest it in something that will go up or down, and over time, when you take the money out, deal with the taxes either later or never. Now, you guys know, if you've ever watched any of the programs that I do here on 15 Minutes of Finance at Wealth Our Way, that I am a big proponent of never paying taxes. In fact, I do a presentation called the 3 buckets presentation. And one bucket is tax now. The other bucket is tax later. And the last bucket is tax never. Now, I'm not trying to pull the wool over your eyes. I'm not one of these guys on the internet or girls on the internet who want to just get you to subscribe to something. So they want to tell you something that's half true or not true at all. I'm going to always give you 100% truth. If there are three buckets and one is tax now, the other is tax later, the other is tax never, everybody would choose the tax never bucket, obviously, because who wants to pay taxes if they don't have to? However, you have to understand logically that there are some limitations on the tax never bucket. The IRS is big business. They are the government. They're not going anywhere, and they're not broke. They got money coming in because they understand how to tax us. So when we're looking at these three buckets, there's a reason I show all three. We need all three. And when we talk about retirement assets, this is when this gets the most crucial. The reason I'm always such a staunch proponent on making sure we adequately prepare for retirement is because the majority of us will not want to work when we're retired. Some of us will not be able to work when we're retired. We'll be older, we'll be feeble, we'll be sedentary. We won't be able to do in our 70s, 80s, and 90s what we can do in our 30s, 40s, and 50s. We have to protect that person. I told you on an earlier broadcast, think of writing a letter to your 80-year-old self on how you're preparing your 80-year-old self to ball out of control in retirement. Because once that money is there, we use the terms on a fixed income, you have a bucket of money, whether it's a small one or a big one, is up to you right now. And when you have that bucket of money, you want to control how it comes out. That's why we started the week talking about Social Security and how to best manage Social Security, because for most people, unfortunately, that's a large part of their retirement income. Hopefully, you'll continue to follow the teachings on Wealth Our Way and 15 Minutes of Finance, and you will learn how to make Social Security a smaller part of your retirement solution, because you'll learn how to fund your own retirement with assets that are growing. With that being said, let's talk about structuring retirement assets, going back to the three buckets. When I'm an employee, I'm normally offered a retirement plan at my job. If you are not, we can still do things with an individual retirement account. But as an employee, more often than not, if I'm at a for-profit company, I'm shown a 401k. A 401k is a plan offered by your employer, sponsored by your employer, I should say, and there is a difference, that allows you to put a certain percentage of your paycheck in up to, I want to say, $19,500 a year, 15% of your salary up to $19,500, and let that money grow without any taxes happening on the growth until you take the money out. Additionally, when you put the money in, the money that you put in is subtracted from your earnings at the end of the year. So when you pay your tax, you're paying tax on less money. That's why they say you get a deduction when you contribute to a 401k. The same is true for a 403b. It's just what happens if you work at a nonprofit or a government job as opposed to a private sector job. So that's if you're with an employer. If you're not with an employer, if you're self-employed like Big Tank and many others, you can open up your own retirement plans. Like I have a solo 401k. I'm probably going to do a whole different program on solo 401ks because they're not extremely complex, but they demand, a lot of explanation, I would say. There are SEP IRAs, simplified employer pension individual retirement accounts. There's a simple IRA. There's always the traditional IRA. There are a lot of different tools that you can use as an entrepreneur to fund your retirement. There are more complex plans, which I will not get into here. I teach those plans for mastery clients and prospects. But all of these particular plans are designed to allow you to put money away that when you take it out, you have either had tax advantage on the growth, or you also have no taxation on your proceeds when you take it out. I sat in a presentation one time back when I was working in retail investments, and I was at an insurance company. Now, there's a difference between insured products and non-insured products. Insured products are guaranteed by the financial strength of the insurance company. Once again, people, don't let anybody fool you. I see some fool on TikTok. I won't call him out by name because I don't like to disparage people, especially he's a brother. I don't want to disparage the brother. But he's telling people, make sure your retirement account is insured. He's using catchphrases that he knows will get people's attention. I mean, oh, I want my account insured. and not fully explaining what that means. So when I worked at an insurance company, everything we sold was insured. It was an insurance company, and it was one of the most reputable and financially solid insurance companies. However, when you get into insured products, the expenses are higher, the returns are slightly lower. Doesn't make them bad products. There's a place for them, but it may not be for you. Everybody, so when I'm out here giving financial information, I'm not giving you financial advice because I don't know your individual situation. And it's the individual situation that matters most. What may be a good idea for person A may suck for person J. So always keep that in mind, that this information is high level. It's designed to get your brain thinking, to know that there's something out there, and to seek a deeper understanding, whether through me or through another source. When you're structuring your retirement assets, you want to make sure that you are setting yourself up to receive your income in the most tax efficient way. One. Two, you want to make sure your assets are structured in such a way that you're not exposed to significant market downturns. The great thing about the stock market is that it has a long track record. We can go back over 100 years testing and checking on how the stock market has done. The bad thing about the stock market is that it's volatile. It goes up and down. When you are younger, that volatility should mean nothing to you. When you have a 30, 40, or even 50-year time horizon, ups and downs mean nothing to you. Think about the fight. Think about the first fight you ever got in. Give you a second to think about it. Maybe some of you have never been in a fight, so think about the first time you got your heart broken. Now, how long ago was that? Do you remember when it happened? You probably do a little bit. Did it hurt like hell when it happened, when you got knocked out, or when a girl told you she wasn't going to call you anymore? It hurt like hell then. Does it hurt today? Probably not. So that's what happens with the investment market. If you're 36 years old and you got $100,000 in your portfolio, you've been saving diligently, and the market goes down 50% and your 100,000 goes to 50,000, oh my God, that hurts really, really bad. But when you remember that you don't need this money until you're 67, and that you have 31 years for it to rebound, and that 50,000 will make itself up 15 times over, it doesn't hurt as bad. And that's what my job is. My job is to make you guys think. My job is to make you guys understand the landscape that you're navigating. So we're going to spend today and tomorrow, as we prepare for the weekend, talking about how to structure our retirement investments so that they are A, safe or safer, and B, tax efficient. So we're going to talk about IRAs. We're going to talk about whole value life insurance. We're going to talk about municipal bonds or municipal bond funds. We're going to talk about annuities. All these things that the pundits get on here and say, don't do this, don't do that, because they're trying to scare you. I'm going to tell you how they work and whether or not they may make sense for you to look into. Everything is not for everybody. But the one thing I can guarantee you is, you do not want to be of a certain age in retirement, go to check your account, and it be zeroed out. So having income for the rest of your life that is guaranteed to come in is very important. That is why we put so much concern and stress and worry on Social Security, because Social Security is promised to be in the mailbox on the first or third of the month every time we go to the mailbox. Y'all hear the chimes in the background? I'm in a very peaceful environment. I need to get away from some stress. I want to give my heartfelt shout outs to anybody who's been affected by this horrible weather that's been hitting the country. I understand Louisiana has gotten torn back. I don't watch TV or the news, so I really don't know what's happening down there. I just see on social media a lot of people giving prayers for Louisiana. So prayers from Big Tank. And then we got hit really, really bad up here in New Jersey, and especially in North Jersey. So I want to make sure everybody in the sound of my voice knows, thinking about you, and I'm concerned about you. So that's what we're going to talk about into tomorrow, these individual assets and individual choices that you can make that will allow you to structure your retirement. Because no matter how old you are, planning is the way to go. An ounce of prevention beats a pound of cure, as grandma used to say. And we have to start planning and structuring things now so that our 80-year-old self will thank us later. Well, I love you guys. I can't wait to see you tomorrow, Friday. We're going to have a great weekend. And, remember our motto here at Wealth Our Way. Wealth is not only for the wealthy. Take care and have a great day.